Inflation is stuck at 2.7%, but traders add to bets on a September rate cut. Welcome to Market Insight. I'm Elena Casas. US inflation is stuck, coming in at 2.7% year on year, according to today's PCE price index. That's exactly the same as last month. That means Fed policymakers are likely to stick with a cautious tone on rate cuts, but markets have nonetheless added to bets that that first cut is coming in September. The odds on that are now seen as roughly even. Well, to find out why, I'm joined now by Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. Matt, hi. Inflation really seems not to be moving from this level. So is the Fed moving farther away from its goal?
We do believe so. So in the last couple of months, to start this year at least, has seen a reacceleration of inflation. It's been tough. The Fed is really been dovish over the last 6 months, and we think that's actually reignited inflation. But today, we did see the bond market change its pricing a bit. We think that might have been weaker readings on some manufacturing reports, more so than the inflation report.
The bond market has been interesting today. As you say, we saw yields come down a bit after rising quite strongly earlier in the week. What do you think is going on there?
Yeah, there was a bit more of a risk-off tone in markets today. I think some of it is selling of the prior winners in the S&P 500. Also, we did get Chicago PMI that did come in at a pretty low level, basically a recessionary level. Now that's one report. But overall, what we're seeing is some weaker data in the US after a very strong Q1. That's probably causing Treasury yields to tick down a bit, more so than the inflation print.
If we stay with the bond market then, Matt, given the size of US government debt, there's a lot more of it coming up for auction in June. Are you expecting to see more upward pressure on yields?
Supply has been a fickle driver of government bond yields around the world. It's actually kind of counterintuitive. A lot of times you see the most indebted countries in the world with higher debt to GDP actually have lower interest rates. It can often crowd out private sector. And what we're seeing, though, is that supply is having limited impact. We think the economy is going to be more impactful in terms of driving interest rates. And we do see the U.S. economy decelerating off of amazing growth in Q1. We think that actually lowers rates. So supply is always something you got to watch for, but really focus on the economy. We think that's going to cause Treasury yields to grind lower as the year goes on.
How do you see this playing out in currency markets? Of course, the US dollar remains much stronger than other Western currencies, given that the US economy has been consistently so much stronger this year, particularly compared to Europe. But do you see that changing?
The euro has actually been gaining ground on the dollar, and the European economy has actually been beating expectations more so than the U.S. economy as of late. So we'll have to see. To us, the ECB next week is likely to cut rates before the Fed. So the June meeting next week, everyone's going to be watching that closely. But if the ECB cuts and the Fed doesn't, usually that means that the currency weakens, all being equal, meaning the euro would weaken versus the dollar. But this risk-on sentiment has helped the euro. The more cyclical parts of the economy doing okay in Europe has helped the euro. But China's also data has been coming in softer. China also can filter into the global appetite for risk in currency markets. If China starts to decelerate and Europe is cutting rates, the dollar might get a bid here in the not so distant future.
If the ECB does cut as expected next week, do you think that could be a useful shot in the arm for European markets, which have been lagging behind the US this year?
It can. The only thing that I would consider is that financials make up the largest sector of the European indices. So financials typically like higher interest rates relative to lower interest rates. So that might be a bit of a headwind for that big sector within the market. But then you've got things like healthcare, consumer staples. You've got more dividend options in European equities. Those like lower interest rates. So you might see a bit of a rotation out of financials, other parts of the market. You also might see smaller cap stocks within Europe do better as they like the lower cost of capital.
On the other hand, in the US, how do you think investors should be approaching a higher for longer environment?
Just being patient. We still like quality parts of the market, good balance sheet companies, high return on equity. Right now, the cost of capital is going to be elevated. We've been underweight lower quality small caps. those companies that lived off capital markets or lived off cheap financing for so many years are going to have to refinance into these higher for longer interest rates. And we think that's going to put them in a tougher position. So we are higher in market cap, overweight the quality factor, and really looking for good quality stocks to be patient with this overall market.
Matt Miskin of John Hancock Investment Management, thank you so much for that analysis. Well, that's your market insight. Don't forget, you can watch more videos on Reuters.com.